We're back with another weekly market review where we analyze the stock market to see if a correction or crash is coming. And it doesn't mean a crash is coming for sure. We're just analyzing the market so we can do what? Have risk management, right? Protect our downside. That's what we're always doing here at Fallible because it is the most important thing in the stock market to have long-term success. And that's why we do these videos every week. So this week we're going to go over a few things. First, the crypto market, then the general equity market, of course. Then we got a few stocks that you should be looking at and possibly selling as well. And then I'm going to answer a question that I've been getting a lot, or it's kind of a question, but more of comments that's really going to help you figure out the best way to approach the market yourself. And you'll see what I'm talking about soon. As always, we'll be using our research from MacroOps, our global macro research and consulting firm. First up, we could talk about Bitcoin. And last week, the Grayscale Bitcoin Trust traded at a 20% discount to its net asset value, which is its largest discount in history. You can see by this red line right here, it has never traded so low. Bitcoin in general here has taken a bit of a bath recently and has fallen, which is crazy to a lot of people because, I mean, look at this run that we've been on. But this is what happens in markets. Things don't go straight up. But in this case, is this bull run over? Because we've had a massive one. I just showed you the chart, right? Well, let's look at it. So we think crypto at large is nearing a top that will lead to a considerable and enduring correction. Meaning, yes, we are closer to the end here. Not the end for crypto. Crypto is for sure here to stay, but this particular cycle. Just like in 2017 when we had that massive run up and then it died, right, for a number of years until this recent run that we just had. This will be similar, but you know, this run up wasn't as extreme as the one in 17, so the correction and sideways movement that we're going to see won't be as bad either. But that's kind of the longer term view of what's happening here. In the more short to intermediate term, Bitcoin is holding at a critical support right now, and it's likely to go on at least one more run before it rolls over. So even in markets, like, you don't see things go straight down. You start seeing a topping pattern form first. So you can see right here, it already rebounded a bit, right? I mean, it came back down, but you don't just have red day after red day. You have some green days split up between there. And even within this trend, you can see this reverse and this actually go higher. Well, actually, there's a few things that could happen. Oftentimes, if a real top is forming, price can dip down, even down to the 200 day, and then rebound back up hard, back to previous highs. So that would be around 66,000. But when it gets to that high point, whether it breaks it or not is a pretty good signal. If it doesn't break it, then yeah, we are in a topping pattern. If it does break it and hits new highs, then maybe we have more of the run left. So that's what we're going to have to monitor in Bitcoin itself as it moves sideways and lower. And like I said, it just doesn't go down all at once. There's usually that topping pattern that forms. Another thing about topping patterns is that it sets a high and a low. So we can see Bitcoin maybe fall down to this 200-day moving average, right? Which will be a support. And if it rebounds from there, then that will be the kind of the key level that we'll have to see it break again. Because say it goes down like this, back up. Well, when it goes down again, it might rebound, but if it breaks lower, then you'll see a nice leg lower. So this is obviously all technical analysis, and it's not some voodoo or anything like that. It's just psychology in a two-dimensional form. So that's what all these charts really are. They're telling you what other investors are thinking. That's why support and resistance lines, why they all work. It's just human psychology. People want to buy at that level. That's how they're formed. Like if a stock falls really low down to its support and all of a sudden people are buying there, it's not because that's just some magical support. It's more that that's a level where people feel there's value and they should come in. And the effect of that, when you look on a chart, is a support level. So it's funny. So I think it's been a few months since I told you guys I was going to buy into Bitcoin, but I still haven't done it. Not because I didn't think it was a good buy. It's because I had other stuff going on with my finances. Money being deployed to different areas. Bitcoin is kind of at the end of the list for me, even though I do like it. So by this point, I mean, if we're going to get this correction, that'll probably be the time when I start loading up on Bitcoin. And again, it's not like I was even waiting for this correction. It's just by the time I get around to it, it will probably be dipping pretty low. And if you guys remember, I was saying that I basically wanted to put 5% of my net worth into Bitcoin and Ethereum, spread it across the two. I just haven't had a chance to do that yet. And if you're doing what I'm doing, which is planning to buy and hold, which is one very simple strategy, doesn't really matter as much when you get in, if you're thinking very, very long term. Obviously, it would have been nice to get in at 20,000 though, versus where we're at now, which is like, what, 52? But I don't really stress about that. And I might have a real good opportunity here as this dip occurs. So we'll see what happens. Moving on to equity markets, trend fragility is still very high. So we're likely going to enter a corrective phase sometime within the next month or so. And what do we mean by a corrective phase? We mean this should dip lower and then go sideways for a while. But markets are still in a buy climax right now, just like we've been saying for the past month, I think. And these tend to end with a FOMO-induced vertical climb where the market runs 5 to 10% over the span of 2 to 4 weeks. So we're likely entering one of those periods right now. The underlying breadth in the market is supportive of such a move. And you can see the breadth right here. You see it as a downswing. These other times it's in a nice upswing right now. And the reason you look at breadth is because is you want all the stocks kind of moving up together in the market. You don't want just a few of the biggest stocks carrying everything on their back, because that's not a strong market. There's some holes in it. It's more fragile if there's no breadth. So strong breadth does give evidence that things will keep going. Now, the reason we say there is trend fragility is because of all the analysis that we do week after week, including sentiment. Everyone is super bullish. People are out over their skis right now in terms of positioning. And what do we know? If people are way too bullish, then that's actually bearish for the stock market. But something that is interesting right now that I think is really going to fuel this buy climax is the fact that a lot of people have been beaten up recently and they're pretty much sick of the stock market. Not only that, but they're tired of being in front of their computers or phones. They want to go out because things are opening up. Now, what we said here is that a FOMO-induced vertical climb will likely happen. Well, what I'm thinking is that FOMO will come from all these people that just kind of exited the market, that are tired of it. Because the truth is, a lot of people are actually losing right now. I know they're not talking about it, and the reason why is because the market continues to climb higher, so you look like an idiot if you're losing. Don't worry, you're not an idiot. But these people that may have pulled away from the market, when they see it start shooting up, few percent a day, which is a lot, right? A 2% day, all of a sudden it's 5 to 10% in a few weeks. Then those people are going to see that, and even though they checked out, they're going to get sucked in one more time. And then they're going to fuel that buying and push it even higher. And that's what you really need. Some people on the sidelines that are going to get sucked back in, right? You want that buying pressure, and that's really going to fuel this buy climax. So what we're saying right here, I could definitely see playing out. Hedge funds have been sitting on the sidelines for most of this rally, but this has started to change over the last few weeks with funds beginning to pile into risk assets. And risk assets are what? Stocks. And this is telling because they have a history of buying into tops. So you can see this upswing right here. After 2 years of sitting on the sidelines, hedge funds have decided that now is the time to buy. So that's something to remember here. So just because we're saying that this buy climax is probably going to happen, and then the stocks are going to correct and go sideways from there, that doesn't mean you pull out your money prematurely. You still want to be invested on the upside here. 5 to 10% in 2 to 4 weeks, that's going to be great. So these hedge funds piling in, they're trying to get a piece of that too, it seems like. JP Morgan published a report recently warning about the dangers of buying into stocks with high growth assumptions embedded into them. So their 20-year analysis showed that close to 75% of those companies in the top quintile of consensus expectations missed estimates and underperformed, while less than 50% of the companies in the bottom quintile beat and outperformed. So basically what they're saying is that the stocks that had analysts rating them highly, saying, hey, they should hit this growth target, which was very high, they usually underperformed, where the people with lower growth targets usually outperform. And here's something to always know about growth stocks and tech stocks and investing in these high flyers. It's all about expectations. So if analysts say that they expect earnings per share to be, say, 2 cents, if a company actually hits 2 cents, you might see the stock price go lower, because what investors really want is for that company to exceed expectations and surprise them. So if they come in at 3 cents instead of 2 cents, you'll see that stock price shoot up. So what you realize here is that it's not about the absolute number of the 2 or 3 cents. It's just all relative to each other. It's all relative to expectations of the actual investors. Now, when a company consistently exceeds those expectations, earnings report after earnings report, you could see it shoot up really fast. But this game is a double-edged sword as well, because if they ever miss those expectations, they get hit hard. So if the expectation is 2 cents and they come in at 1 cent, where they've been growing strong all year, their stock price, you might see it correct 20-30% in just a few days. So it can get really dangerous. And the way you survive that, of course, is with proper risk control and risk management. So sell some shares on the way up, move your stops up as it keeps flying higher, so that when it does get knocked down, you get out and you have much less exposure, you don't lose much, you keep most of your profits. That's solid risk management, especially in growth names. Right now, there's some incredibly extended charts in the growth and tech space, such as Google. Their stock is currently trading 30% above their 200-day moving average. And in past cases where the stock has traded this wide from its 200-day, its follow-on performance has been dismal. So you can see right here how far away Google is from its 200-day, which is this blue line. Now, markets move in two ways, right? They trend and then they mean revert. So we've been seeing some pretty crazy trend out of Google recently, right? But eventually that trend will mean revert. That's why we use moving averages too, because we know after a while it will come back down to its average. So you can see, like, even from this trend right here, it's going up, but along the way it's not going straight up. It keeps mean reverting back to its average, which, you know, the average is increasing as becoming higher. But that's what we talk about, trending and mean reverting. It happens at different scales too. So you could say this is one big trend. You could also look on a smaller time frame and say, hey, no, it's mean reverting a lot. You could zoom back even further, and now I'm on the weekly time scale right here, and say this is a big trend, and then we're going to have a big mean reversion back down here. So again, it's all fractal. It depends on what time frame you're looking at, but you can always expect in the stock market when something gets too far away from its average, it will likely come back down to that average. So our team recently just finished reading Moore's Law, an investor's guide to the new agrarian revolution. So it's written by by investor Jim Mellon. So he's really bullish on the future market for lab-grown meats and makes a compelling case for being so. Now the stock that we're looking at, Aquabani Technologies, which is AQB, it doesn't do lab-grown meat, but they do grow and sell real fish. Actually, they sell salmon, but that salmon has been genetically modified. And the company has been working on its tech for years and recently got approval to bring its product to market and is finally starting to do so. So it's really interesting food technology here. Now our team is still looking into this company, but we're pretty bullish on the entire food sector, especially in the companies that are making these technological advances. And the reason why we're bullish goes into our broader macro theme of what's happening in India and China, and actually around the world in general. Way more people are moving to a different economic class where they could finally afford meat, and that is going to put a huge strain on the global meat supply. So these companies that are figuring out different ways to produce meat and grains and everything to feed all these new people that now have money and can buy it, those companies are going to be interesting to invest in. And this is a multi-decade thing that's going to play out. And it's one that we're going to continue to track because there's a lot of money to be made on it. Now, I've been getting a lot of comments and questions lately, so I figured I'd address it in this video. But what I wanted to say is that it is extremely important for every investor to really solidify their goal in the market. Now, what I mean by that is that there are many different ways to approach the market. So for example, in all this research that we just went over, this is mostly global macro stuff, because that's what macro ops is, right? We're a global macro research and consulting firm. So a lot of our clients are managing billions of dollars, and when they have to make their huge allocations of all this money, they need research like what we've talked about in this video. What are the big trends that are happening? Where are we going from here? What's the economic backdrop? And based off that information, they make their big moves. Now that strategy of approaching the market and that level of money might be very different from another person who is smaller and trades more frequently. That smaller trader may be more focused on things moving day to day. So what stock is popping off this week versus next week? And this particular person may be way more active trading in and out of stocks, watching this market every single day. The macro outlook may not even matter to them because they're playing on a day-to-day basis and they don't have to make the huge allocations as the bigger guys. So you can see that both are very different, but both can be very profitable too. Another example is our Fallible system, which is a momentum system. And you guys already know we have this TSI scanner that basically ranks all the stocks in the NASDAQ by their momentum. Gives us a little number right here. And then what we do is invest in the top 5 highest momentum stocks every month. And we change our portfolio each month so that we are in those stocks that are moving highest the fastest. That's the whole point of momentum, right? Now our system is a professional level system. So we're contracted with many funds that actually use the same system for their momentum strategy. So it's professional level, but at the same time, it's very efficient. So I myself and all our Fallible members using it and the funds as well, they barely have to look at the market if they don't want to. Now funds are a different case, but myself and the Fallible members, yeah, we don't need to, because the model spits out alerts anytime there's a need to buy or sell. And honestly, there's not that many alerts. And that's not a problem with the system. It's actually a feature because it is super efficient. It's not extremely active, but it still gets incredible returns. And the benefit is that you don't have to spend a bunch of time on it. Now, here's the thing. I love this type of system, and all our Fallible members do too, because we got other stuff to do. So we don't want to sit in front of the charts all day. And that's what works for us because we got, full-time jobs and doing things like that. For me, it's YouTube and our research company. For others, they're doctors, teachers, lawyers, whatever. But here's the part where you have to define what you really want to do. Some people want to be super active in the market and stare at the thing all day. In that case, you might as well be more on the day trader side. And yeah, spend all your time there. Like I said, it can be profitable. But for me, I wouldn't like that. For a lot of our Fallible members, they're not into that as much either. We prefer the more longer term, more time efficient method. But it's true that it's not for everyone. I've met very successful quants that literally get bored of the business because they build a system, just like ours. Different strategies, of course, because there's a million different systems you could build. But at the end of the day, if you're a good quant, it basically comes down to pushing a button. You push the button, you make money. But these quants, they get bored because they're like, yeah, I did it, we make money, but I need some more action in something. So these guys either build more and more systems or they start another business. The point that I'm trying to make here is that there's many different ways to be successful in the stock market. But what's most important for you to be successful is to pick a strategy or a system that works with your personality and what you want to do. Because for me, even if I had a profitable day trading system, because it doesn't match with my personality, I'm not likely to make profit off of it. I'd probably screw it up, either consciously or subconsciously. Same reason why I stick to momentum instead of global macro, because global macro is way bigger and more long term, which again, won't work out for my personality as well. So my sweet spot is a Fallible momentum system because it's high returns, low time commitment, and easy to execute. That's That's what I want. That way I could fool around and make stupid videos on AK News. That's what I want to do. So all this other stuff has to be automated. But you always got to remember, pick the strategy that works for you. And if you want more information on how we execute our strategy, then you can always check out our free training right here. I'll put a link to it in this video and down below in the description and comments. And in that training, we go through step by step exactly how our strategy works so that you could use it yourself. So just click right here to go to that training. Check it out. See if it fits with your personality and your goals in the stock market. It does for me and it does for our Fallible members. Maybe it will for you too. So click this link and I will see you in that training.